Assalamualaikum warahmatullahi wabarakatuh. Let us now go to the second source of profit from the loan rate. The loan rate is the interest rate on conventional loan, whereas the profit rate is the finance charge on the tawarruk or murabahah facility or the ITAB facility. All right, so I'm using this loan rate and profit rate interchangeably because we have to somehow see that the regulation provides a guideline for both Islamic banking and conventional banking, and the way how the current Islamic products are structured or programmed, they are very similar with conventional loan. So in a sense that we can, compare loan and murabaha, loan and tawarruk, and there should be any, because these are debt financing products. We are not referring to the equity or mudarabah product, which is equity in nature, and that will somehow will change the whole equation. So we just cannot use profit and loan rate when it comes to mudarabah or equity-based financing. So we are dealing with tawarruk and murabaha which are essentially debt-based financing, like any of the interest-bearing loans in the market today. So the second source of profit is coming from the interest rate charge based on the credit standing of the borrowing party. So this is the credit risk spread. So the spread is the extra interest rate that the bank charges based on many factors, right? Because the spread in general is not simply the additional interest rate arising from the credit risk, but it can also be related to overhead spending, the opportunity costs from the reserve and liquidity requirement, and so on. But our main focus here is the spread arising from default, arising from the credit risk of the customer. So for example, the credit risk spread for high quality prudent borrower is 2%. So there is an additional interest rate of 2% charged onto the high quality prudent borrower. However, if the borrower has a lower credit standing, meaning that the borrower now will be a risky borrower, then in order to compensate the bank for receiving that risky customer, then the bank would charge a higher rate, say 6% over here, right? So the high quality prudent borrower is a less risky customer where the bank charges interest rate of 2% spread, whereas the low quality risky borrower, the bank will charge an additional 4%, and that will be 6%. So the extra profit from the risky loan will be 6% minus 2%, and that will equal to 4%. So the bank, if the bank is pursuing a risky strategy, of course there are limits, to the credit concentration, and meaning that we don't see that 90% of the loan portfolio would be comprising of risky loan. Of course, there is some stop limit. For example, 20% of the portfolio, must not exceed, meaning that the risky loan must not exceed that 20% so-called threshold. And here we can see that when the bank is pursuing that particular strategy of making risky loan, then they can make an extra profit of 4%. Right? If the bank wish to just go on to offer prudent loan, high quality prudent loan, then the bank, of course, will be will not be making an extra profit of 4%. They will make a profit of 2%, but yet the upside will be that the danger of default will be much lower compared to the default arising from the low quality risky borrower. So this is how we are looking at the loan strategy or the financing strategy of banks, that if they want to make more money by charging higher interest rate or higher profit rate, then they have to somehow downgrade their asset quality. And that, of course, will have to be approved by the board of directors based on the risk appetite policy of the bank. So we can see here that a loan rate in general is the sum of cost of fund plus the spread. But then when we look at in a more specialized way, the loan rate will be using OPR as the cost of fund, and the spread will mainly coming from the credit risk spread. So that would be the additional rate based on the credit standing of the customer. Okay. If you look at case 1, where we are dealing with a secured loan or a secured tawarruk, these are coming from like housing loan, motor loan. These are collateralized financing, and let's say that the rate is averaging at 6%, right? And if it is 6% over here, and the bank is using OPR as the base rate, 3.5%, so the spread of the loan rate of 6% is 2.5%, right? So when the bank is making a secured loan or a secured tawarruk, then at 6% average per annum, then the spread of the interest rate charged on the credit standing of the customer is 2.5%, and that is considered to be quite thin. And the bank, in order for the bank to make more profit, the bank cannot rely on the spread to make profit. They have to rely on more and more loan sales, right? So the marketing must be aggressive, getting as much customer as they can, and therefore maximizing interest revenue by way of the size of the loan. When we look at unsecured loan and tawarruk, that this is profit coming from risky loan and murabaha or tawarruk. And these are coming from personal loan or credit card, so the rate's averaging at 15%. And the financing rate is OPR plus the spread. So if you look at the average rate of 15% per annum that uses OPR rate as the cost of fund, then we can see that the margin that the credit risk spread is at 11.5%. This is huge, compared to the earlier spread from the secured loan or tawarruk at 2.5% only. So this is again why that many banks are pursuing a much more aggressive position, to secure them more profit. So by taking in more risky customer, so that they can charge higher credit spread. But this is again, the downside would be default, that the bank will have to put up a lot more of the loan impairment provision in view that if there's a default, then the provision will take care of it. Or if the default is exceeded the loan impairment provision, then the loss will have to be covered by banking capital. Guys, so I think this is a very interesting analysis of how bank actually generate profit from their loan and financing businesses. And the question, are the bank making too much money? So later on, we can look at those issues once we have understood the sources of profit that is coming from the loan rate or the profit rate. Inshallah. Okay, guys. Okay, I see you again. Thank you very much. Assalamu alaikum warahmatullah.